Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. And this week's video, we will be discussing what was the most anticipated Canadian economic data point to come out in ages, especially for me, if you're a nerd about these things. And it was the survey of employment, payrolls, and hours. As I've mentioned several times before, it is the more accurate but less timely of the two employment data sets, with the labor force survey being the other one. We're also going to use the payroll data to highlight troubles we are seeing in the manufacturing sector and how things might be about to change. So today's December data show that payroll employment dropped by 35,400 jobs. This is a decline of 0.2% in a single month. November had already shown little to no growth, and so now we're seeing back-to-back months of weakness. It's even more depressing if we zoom out. Canada actually had 2,800 fewer jobs in December of 2025 than it did a full year ago. We're not just stalling, we're starting to move backwards. And this chart tells that story perfectly. The blue line, total payroll employment, has essentially gone nowhere since 2024, and the 12-month moving average of monthly job changes, the red line, is now negative. So where are the jobs going? Well, this chart breaks it down by sector, and the color coding tells an important story. Red is goods producing, blue is services, and green, which seems to be always positive, is government. Construction was the minor bright spot, adding 2,600 jobs, and healthcare chipped in another 2,300. But that's where the good news ends. Look at the bottom of the chart, and you can see that manufacturing lost 7,400 jobs in December alone. This is the single biggest drag by far, and it's not just a December story. Since January of 2025, manufacturing has shed over 40,000 jobs. That's a sector in serious trouble. More on that in a little bit. Wholesale trade lost another 6,300 jobs. Transportation and warehousing dropped by 5,900. And accommodation and food services shed about 5,000. This chart suggests that December's biggest losers are all the service and goods producing sectors exposed to tariffs. Zooming into manufacturing, and the chart again is not pretty. Total manufacturing employment now sits at about 1,523,000. That's the blue line. However, it's important to note that it peaked back in early 2023 and has actually been grinding lower ever since. Of course, the recent job losses in manufacturing don't tell the full story, so let's zoom out even further. This chart shows us three key measures of manufacturing health: output, shipments, and employment. And they're all pointing in the same direction, and they have been for some time. And this tells us an uncomfortable truth. Canadian manufacturing was already in recession long before U.S. tariffs arrived. The downturn began in May of 2023, making this the longest manufacturing recession in at least a generation. Activity is now at its lowest level since 2013, excluding the pandemic, of course. So how do we compare with other countries? Well, this is a chart of manufacturing GDP rebased to 100 back in 2013. And since then, we can see there's two very different stories. U.S. manufacturing GDP is up 24% over that period. And yes, while U.S. tariffs are absolutely making things worse for Canada, we have to be honest. Domestic policy failures are the main reason Canada's manufacturing sector continues to languish. High taxes, excessive regulation, uncertainty around natural gas and electricity inputs, and yes, the carbon tax applied to the very industries fighting for survival have all served to make Canada an uncompetitive place to manufacture all manner of different goods. The data is clear. This isn't just an American protectionism story. Canada has been letting its manufacturing sector down for years, and the bill is finally coming due. In the previous charts, I've showed you that Canada's secular or structural decline in manufacturing is actually accelerating. But this chart suggests that there's a cyclical upturn that might be underway. That's the blue line. Manufacturing PMI, or Purchasing Managers Index, has actually edged back above 50 in January. This is the first time in about a year, coming in at 50.4, up from 48.6 in December. Above 50 means expansion, and below means contraction. This is a meaningful, if tentative, signal. Output has stabilized, confidence has improved, and hiring intentions have actually picked up. Remember, payrolls are a lagging indicator. There are genuine green shoots here. But before we get too excited, the tariffs are still biting, despite the most recent announcement from the Supreme Court. I'm not going to talk about that because we still have no idea really what's going on. Nevertheless, exports continue to fall, particularly to the United States, and input costs have surged. This has forced manufacturers to raise prices at the fastest pace since March 2025, and this means that margins are being squeezed from both ends. Manufacturing in Canada might be facing a cyclical floor, but there are structural challenges that I think are completely unresolved and are likely going to get worse with the implementation of even higher carbon taxes. The reason this cyclical improvement in Canada's manufacturing sentiment is important is because of the broader global picture. This chart tracks two key measures of global trade activity. This is from a CPB trade index. It's an outfit out of the Netherlands that tracks global trade and export volumes and prices and import volumes, all kinds of wonderful things. And the message is encouraging. Global trade is actually growing year over year. Now, this is in stark contrast with the growing negativity on the markets, but it's clear that the CPB trade index is up 4.1%, and real export volumes are up 6%. So there's a paradox that Canada finds itself. Global trade is improving, and yet Canada is losing manufacturing jobs and export share. The tide is rising, but Canada's boat isn't lifting with it, and that is a real concern. When global trade is weak, you can explain away poor export performance and poor manufacturing performance. But when the world is buying more and more goods and we're still losing ground, that points to a structural lack of competitiveness. It's something we've talked about a lot and is, of course, related to productivity. The opportunity is there. The question is whether or not Canada is poised or positioned to take advantage of it. All right, that's a wrap on this week's episode. Thanks again for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world.